come back to help her dad. Let's dive into stock market sectors and how understanding them can help you earn potentially huge profits. We'll start with a brief overview of what stock market sectors are, emphasizing the importance of understanding them for investment purposes and highlighting the potential for higher returns through sector-specific strategies. Remember though, investment involves risk, and this is not financial advice. So, what exactly are stock market sectors? They are basically groupings of companies with similar business activities. The purpose of classifying companies into sectors is for analysis and comparison of company performance. A standard classification system used is the Global Industry Classification Standard, or GICS. Some common examples of sectors include technology, healthcare, energy, and financials. Now, let's explore some of the major stock market sectors in a bit more detail. First, we have technology, which includes software, hardware, semiconductors, and IT services companies. This sector is known for its growth potential, innovation, but also high volatility. Think of companies like Apple, Microsoft, and Nvidia. Next is healthcare, which comprises pharmaceuticals, biotechnology, healthcare providers, and medical devices. This is often seen as a defensive sector, driven by an aging population and continuous innovation. Key players here are Johnson & Johnson, United Health Group, and Pfizer. Then, there are financials, consisting of banks, insurance companies, and investment firms. This sector is highly sensitive to interest rates and heavily impacted by the economic cycle and regulatory oversight. Examples include JPMorgan Chase, Bank of America, and Visa. We also have consumer discretionary, which includes retail, apparel, restaurants, and automotive companies. This sector is very sensitive to economic conditions, driven by consumer spending and brand loyalty, and includes companies like Amazon, Nike, and McDonald's. On the other hand, consumer staples consists of food, beverages, household products, and personal care companies. This is considered a defensive sector because of its consistent demand and less cyclical nature, with examples being Procter & Gamble, Coca-Cola, and Walmart. Moving on, energy focuses on oil and gas exploration, production, and refining. This sector is heavily dependent on commodity prices and faces geopolitical risks, especially with the renewable energy transition underway. Major companies here include ExxonMobil, Chevron, and Shell. Next, industrials covers aerospace, defense, machinery, and construction. This sector is dependent on the economic cycle, infrastructure spending, and manufacturing. Examples include Boeing, Caterpillar, and General Electric. The materials sector includes chemicals, metals, mining, and paper companies. This sector is sensitive to commodity prices and is a key input for construction and manufacturing. Examples include Dow, Freeport-McMoRan, and Nucor. Utilities provide electricity, gas, and water. This sector is defensive, consisting of regulated monopolies with a dividend focus. Key players include NextEra Energy, Duke Energy, and Southern Company. Real estate includes real estate investment trusts or REITs, and property developers. This sector is sensitive to interest rates and is influenced by property values and rental income. Examples include Simon Property Group, American Tower, and Prologis. Finally, communication services covers telecommunications, media, and entertainment. This sector is influenced by technology convergence, changing consumption patterns, and regulatory changes, and includes companies like Alphabet, Google, Meta Platforms, Facebook, and Netflix. Oh, how do we go about identifying sector trends? Keep an eye on economic indicators like GDP growth, inflation, and interest rates. Also, Monitor geopolitical events like wars and trade agreements. Technological advancements like AI and automation play a significant role too, as do consumer behavior shifts, such as the rise of e-commerce and sustainability. Finally, stay informed by following company earnings reports and news releases. Now, let's discuss the sector rotation strategy. This involves shifting investments between sectors based on the economic cycle. In the early cycle, focus on discretionary, technology, and industrials. In the mid-cycle, shift your focus to financials, materials, and energy. And in the late cycle, consider consumer staples, healthcare, and utilities. You can implement this strategy using ETFs or individual stocks. In analyzing sector performance, consider the relative strength by comparing sector performance to the overall market. Use price charts to identify trends and patterns. Evaluate company fundamentals within sectors using financial ratios like price to earnings or PE and debt to equity. Keep up with sector-specific news to stay informed. It is important to be aware of the risks and considerations involved. Avoid sector concentration by not overexposing yourself to any single sector. Be careful to avoid incorrect timing by misjudging economic cycles. Remember that market volatility can lead to unpredictable market fluctuations. Also, factor in company-specific risks such as poor management or intense competition. In conclusion, understanding stock market sectors is crucial for making informed investment decisions. Sector rotation has the potential to enhance your returns, but remember that continuous learning and adaptation are essential for success. So start researching sectors and building your investment strategy, and take action today. Thanks for watching. See you next time on Helper Dad.